to Brashenomics. Now, a lot of other radio shows might be gifting you guys Justin Bieber tickets for tonight, and unfortunately we're not, but we are giving away lots of good information, and in fact, John Hugg joins us, who specializes in estate planning, business succession planning, and elder law, and is a frequent speaker on these issues and host of informational seminars throughout the Seattle area. And first of all, welcome, John. How are you?
Well, thank you, Ben. I'm doing fine.
Good.
How about you?
I'm great. I'm great. We aren't giving away tickets like a lot of other radio stations may be.
Well, that's too bad.
But I know, right? I'd probably, who knows? Who knows who would get them? I'd probably give them to you, John.
Yeah,
I know
I would use them.
You got Bieber fever, don't you?
Well, I have for years.
But gifting actually is one of these areas that is more complex than just throwing gifts under the tree or whatnot, or giving away holiday gifts, birthday gifts. When it comes to much larger sums of money,
exactly.
Let's talk a little bit about gifting and maybe how that really ties in with the law and with tax implications and whatnot.
Right. Well, as we're moving towards the end of the year, I mean, it's October, and we're already headed towards Christmas and the holidays and the end of the year. A lot of families tend to do gifting at that point in time. They make that one big gift to the children or the grandchildren and write that check and whatnot. So I thought it would be an appropriate time to sort of talk a little bit about that. And you're right, a lot of people do make simple gifts, gifts under the tree, but then there are larger gifts, usually monetary gifts, or gifts.
I like those, John.
Well, don't we all? If you can get them, that's great.
Yeah, boxes of money under the tree. That's what I always root for.
That would be perfect. That's what I need for Christmas.
Yeah.
Exactly. So, but basically, if you have something, you can give away anything that you own naturally. And Washington is a really conducive state for that, because we do not have a gift tax. There's no gift tax in the state of Washington. So if you're going to make a gift, this is a good state to be in when you do that. However, the federal government still does tax gifts. And at the moment, the tax rate on a gift is 35%. And that's actually, historically, that's a little low. Normally it's been a little bit higher, up around 50%. But it's part of the Bush era tax cuts and whatnot. And then the party that is actually making the gift, that's the person that is supposed to pay the tax. The recipient of the gift doesn't pay any gift tax, doesn't pay any income tax or anything like that. And I get that question a lot. A lot of people think that if they get a gift, they got to pay income tax.
As if it'd be like income or whatnot.
Right, but it's not. So that's not really a problem.
So the gifter gets kind of hosed twice, don't they?
Well, they may, but there's a number of different things that apply so that you rarely will have to pay a gift tax. The first and the biggest thing is that at the federal level, there's a $5 million per person exemption for making gifts. Now that is set to expire at the end of the year, and will probably roll back to $1 million if Congress doesn't act to extend that. But at the moment, it's a $5 million per person exemption. And so if you're going to make a large gift, for instance, if you're going to gift your house, and I'll talk about maybe a situation where that might be applicable, this is what you would do. You would apply your gift tax exemption and just file a simple form with the IRS when you do your taxes the following year. Now, for most people, what a lot of people do is they make smaller gifts, and so if you make a gift, and everybody is allowed to make gifts of $13,000 per year, per person, to anyone. So I could give you $13,000, I could give Heather $13,000, and we don't even have to, declare that.
Yeah, Heather's over there clamoring for 13 grand. I was going to hit you up for $5 million, but...
Well, I can't make either gift, so I guess you're out of luck. So that's one thing that most people do. They will make smaller gifts, and they may make them, say, to all of their children, all their grandchildren. So they'll write maybe checks to 2 children of maybe $5,000 each, and then you got 3 grandchildren, five more checks, or three more checks of $5,000. You've given away $25,000, and you don't pay any tax because you're within that $13,000 exclusion limit, and you can do that each and every year. So that's kind of a benefit, and a lot of people take advantage of that. And if you've implemented a gifting program, I mean, that's kind of what you would do. You would go ahead and do that on a regular basis.
So it sounds to me like gifting, although maybe sounds so simple around the holidays, when it comes to large sums of money, There's a lot more planning around that.
Correct. There's one real simple plan. For instance, if you have a child who's going to buy a house and they don't have the down payment, let's say they need $50,000 for a down payment. One of the things that you can do, so let's say that Junior has 2 living parents. The parents can double up on their gifts. It's called gift splitting. So basically, the dad can give $13,000, mom can give $13,000. So as you come towards the end of the year, you give $26,000 to Junior at Christmas, and then a week later, you're in the new year. You're in 2013. Go ahead and give the second $26,000 at that point, and now your kid has the down payment that they would want for a house. So that would be one simple gifting strategy that you could do.
You know, another one we've seen on houses is even for the parents to go into title on the property, so that they're kind of in some ways buying it together.
Right. Certainly, you can do that, and you don't have to just give away money. I mean, you can give away an asset as well. So you can give away, you can give your 16-year-old kid a car, and technically it should be. I mean, to not report it, it would need to be within that $26,000 limit. Hopefully, most people aren't giving
their kids
$50,000 cars. I know this is Bellevue, so that's probably
they're safer, John. They're safer.
Exactly.
Plus, I mean, I got to get rid of $5 million somehow before the end of the year.
Right.
We're here with John Hugg, attorney at law with Hugg and Associates, and John, we do have to go to break in just a couple minutes. Sure. But so you look at these gifting strategies. What about longer term strategies to transfer money?
Mm-hmm. Well, one longer term strategy, you could, like I said, you can implement a regular gifting program where you're gifting money each year. Other things that you can do, and this is another sort of leveraging type strategy, you can pay for your children's or your grandchildren's college tuition, and that won't count against the $13,000 per year exemption. So if you've got a $20,000 tuition bill, as long as you pay that directly to the institution, don't pay it to the kid first and then have them pay the bill. You can pay it directly to the institution. That will count as a gift, but that won't count against the $13,000. So you could then give them an additional $13,000, for room and board and whatnot, and transfer even more money out of your estate. And you can do the same thing for medical bills. So if somebody has uncovered medical bills, if you pay the provider directly, that's totally permissible, and it won't count against. That would be a gift that is permissible and would not count against the $13,000 as well. So there's some longer-term strategies. And then other things, too, is you could set up trusts for children or grandchildren and make annual gifts to that trust. And a lot of times, the trustee would then purchase one common strategy would be to purchase life insurance. So then when say, Dad passes away, the life insurance pays off to the trust. Now you've got a couple $1 million worth of income or cash in a trust that you basically set up by making $13,000 a year gifts to pay the premiums in previous years. So there's some strategies to not only get money out of your estate, but also leverage it into perhaps a larger benefit for children and grandchildren.
And I thought all you had to do was write a check to the grandkids, put it in an envelope and under the tree, and everything was fine.
Well, that works too.
Yeah.
That absolutely
works. Of course,
works.
Not everybody's just writing the $15,000 check or $13,000.
That's true. And then, there's some circumstances where you may not want to be making gifts. I mean, and certainly the most obvious one is if you really don't have that money to give. You probably don't want to make the gift just because you can. You need to think about what you need going forward in terms of your costs, your long-term care, things like that. If you're older, does it make sense to make a gift, even if it's maybe desperately needed by the child or grandchild? And another thing, too, is if you're older and you're looking at long-term care costs and you're looking at using or applying for public benefits to assist with that cost, there is a 5-year look-back period from the date that you apply for say, Medicaid benefits, where we're going to look at every gift that you made and add them all up, and that will potentially disqualify you from receiving benefits for a period of time. It doesn't mean you can't get Medicaid benefits. It means that you'll be disqualified for a period of time, and depending on the gifts that you gave will determine that period of time. So if that's something that you need or you think you're going to need in the near future, you might want to think about the gifts that you have made and the gifts that you may be looking to make in the future.
Well, John, every time you come on, you make me realize why it's so important to have a full team in place. And to go back, because it's Justin Bieber Day, but to go back, he doesn't go on stage without his entire team and his roadies and the people setting up the stages and his manager and Carly Rae Jepsen opening for him. But he doesn't go on by himself. I mean, he does, but he has a whole supporting cast. So, everybody, I think, is the own rock star of their own life for the most part, right? I mean, take care of old number one. People try to do the best for themselves. But everybody also needs a supporting cast around them. Yeah. And having an attorney like you who can help people do something that seems as easy as just giving money away, but doing it more effectively is certainly a team member that people want to have. John, thanks so much for joining us. We do have to go to break. Again, John Hugg with Hugg & Associates. When we come back for the first time, Devin Sanford is going to join us. We're going to talk a little bit more about the involvement of team members and making sure the team members that you have on your team care. We'll be right back.